Well, let's welcome on board Bhaskar Bhat, MD at Titan Company Limited, to chat about their numbers. Machine may be missing, but they've surely managed to keep up with the jewellery revenue guidance. Mr. Bhat, hi, good morning. Despite all the stress in the system and all the liquidity issues being flagged off by consumer-facing peers, your jewellery business has actually grown healthy. What aided that?
Well, we have been consistent. It's a combination of several things, but to begin with, you are aware that we have been pushing the adornment part of jewelry very strongly ever since inception, but more recently in the past, as we see the market moving away from investment to adornment. But be that as it may, significant network expansion as well. We are seeing opportunity in Middle India. Small towns are growing very fast. The desire for owning branded jewelry has grown, and that is a combination, of course, of wanting to buy from a trusted jeweler and good designs and a reputed brand. The third bit is, I think, to do with migration. We do feel that there is, thanks to the formalization of the economy, a lot of customers, apart from trust and design, they want to buy from safe jewelers. And last but not the least, it is the low market share that we still have despite being the market leader. So there is a lot of headroom for brand Tanishq and the other brands in the jewelry business for us, Carat Lane as online business grows, and Mia and Zoya and so on.
And I guess that's what the market as well is liking. But tell me, Mr. Bhat, you faced a 37 crore rupee hit on your EBITDA because of subdued gold prices. How will the movement in gold prices affect your financials going forward?
No, well, let me explain. This is the way you account for the stocks. That is the impact. It comes back in the next quarter, because this is a stock valuation issue, and it's technical in nature. It is not to do with because for us it's everyday pricing, so the price of gold is a pass-through. So if you ask me, it has not affected sales in any significant manner during the last few months. But the 37 crore is more an accounting treatment of stock.
Mr. Bhat, we also understand that you have seen better traction when it comes to the high margin wedding jewelry segment with respect to the help of your new collections as well. What has been the growth and the contribution, and what is the outlook here?
Wedding jewelry has been growing quite healthily for us. It's now contributing to 20% of the business. The wedding jewelry growth comes out of again two initiatives. One which is clearly making a special case for customers out of buying for their for the wedding in the family through what is known as bundling offers, which means, you know, as you buy more, you get more discount, because it's a single occasion in the life of, or a few occasions in the life of a family. But in addition to that, the larger strategic move in the jewelry division is to make jewelry which is relevant for weddings of communities, so community specific designs. And there are a large number of communities in India, so if you have to grow in that segment, you have to behave like a local jeweler in terms of product offering, pricing, but still remain a national brand. I think we have succeeded very much in that. In the last 1 year, we are appealing more to local, very micro segments of the market, and those are large segments by themselves. It is still low in terms of market share for us, because while we are a very large player in the wedding jewelry segment, in the sorry, in the diamond jewelry segment, on occasion-led wedding jewelry play, we came relatively late into this segment. So we are trying to play catch up. So the growth is much higher than the rest. Contribution 20%.
Now, after 5 years of single-digit growth, your watch business has finally seen double-digit growth. Is this largely on account of new launches, and do you think that this kind of a momentum can sustain in FY20 for the watch business?
Certainly, it's a combination of two things. One is recrafting the business as it was, because we are very good at responding to market conditions. So the watch business, not just watch business, watch industry has changed fundamentally. It has moved out from timekeeping to an accessory now, and it is really design and innovation-led growth. We are still the largest players in the Indian market, with the market share over 40% by value, 65% in the organized sector, etc., etc. However, the change is that now customers, unlike in the early days, they are multi-brand oriented. So they would like to own multiple brands and multiple watches. So we are now offering through our own brands, which are Titan, Fast Track, Sonata, Nebula, Xylus, Raga, etc. We have a large number of licensed brands as well, like Hilfiger and so on. In addition, the Helios retail chain, catering to the needs of multi-brand or the multi-brand nature of the demand. So this is on the traditional side, and that has delivered very good growth. Apart from that, there is a new play which we started a few years ago, but more aggressively in the last couple of years, is in smartwatches and wearables. For the benefit of our viewers, we now are the second largest wearables company in India, as assessed by an independent agency for 2018-19. So that will bring more customers into the fold of the watch business. So if you ask me, the growth in volume is powered by Sonata, Fast Track and Titan and wearables. Value growth is through the premiumization route in brand Titan primarily, and the Helios play through licensed brands, and even including in the large format stores, our growth has been very good. But the interesting thing in the change in structure in the watch business is a very, very positive and significant growth in the new channel, which is online. We are very large online, very profitable, and that is bringing new customers as well.
Oh yes, online's the way to be, right? But Mr. Bhatt, you've made an ex gratia provision for employees in the watches business, as we understand. But if one has to strip that one-time provision away, tell me, how was the watch margins exactly?
The watch margins have grown, as you can see. The only thing is Q4 is always a weak quarter for the watch business. But this ex gratia, first of all, let me correct, it is not for the watch business. The ex gratia payment is for everyone in the company. This is something that the company does on reaching its own targets. The idea is that it is a collective achievement, so everyone gets the benefit of the company achieving its bottom line target. So it's paid to everyone. Otherwise, watch business, as you can see, margins have improved. The PBT growth is higher than the top line growth, and it will continue in this manner. The double-digit growth that you asked about, yes, it will be double-digit for the current year as well. And margin improvement through a combination of, as I said, premiumization and focus on cost is what will deliver margin improvement.
Let's get back to jewelry, because earlier you were talking about Carat Lane, and clearly you've upped your investment in this particular segment, which has grown at a CAGR of about 42% over the last 3 years. Is competition a problem there or not yet? And has the business really turned profitable?
It's not yet profitable,
Okay.
but it will soon be profitable. It will grow even more significantly in the coming years because we don't see much competition yet. The competition that was there at the time we bought this company or bought a significant stake in this company, it remains at the same level. If anything, Carat Lane has become stronger in online play. The margins have improved, so you will see profitability kicking in very, very soon. And we have a large number of brick and mortar stores, so it has moved away from a, let's say, a relatively pure online play to an omni-channel play as far as Carat Lane is concerned.
Sure, Mr. Bhat, everyone wants to know as well, going forward, what exactly is the outlook? You've guided for a 20% revenue growth. That's fairly healthy in FY20. What makes you optimistic despite the weak cues, as well as reasons like liquidity that are being flagged off by the consumer-facing companies?
Well, our model is to develop our targets bottom up. The store where I am sitting, which is our largest jewelry store, South Extension, Tanishq. It comes from the people in the store, what they can do for next year, how they find, what opportunities they find for growth. So our 20% across the company is based on very micro level planning of targets. So our target remains that. We normally don't provide guidance, so on top line, it's a 20% growth is what we are budgeting.
Mr. Bhat, it's been
It is going to be difficult because we see headwinds in the consumer business, in consumer products, other consumer companies, and we are aware of that. But our model, of having retail outlets spread across the country, widely distributed, our processes of listening and responding are getting better and better. So agility is the name of the game. So as if we face headwinds, we have many tricks up our sleeve to play to get to our target.
Hope those tricks play out very soon for you, and must tell you that the consumer experience at a Tanishq store is by far the best. So I'm sure your team is doing a great job, which
Thank you.
Personally I can say it is, and you grow higher from here as well. But great speaking with you, Mr. Bhat. Thank you so much for taking the time out.
Thank you.